Good evening, everybody. Uneducated Economist here. So in this video, we are going to be talking about monetary policy and how it is impacting the economy today. Earlier, All-Nighter Hider had sent me a message with a link to a Joseph Wang video. He says, hey man, go to 15 minutes, 45 seconds, I think is what it is, 15 minutes, 23 seconds. And he says, listen to this part. You'll be really interested in what he has to say. So, of course, it's All-Nighter Hider, so I got to listen to it. And this is where it goes. It goes down like this. Listen.
The last thing I want to talk about is about the Fed's framework. Now, Chair Powell gave an interview the past week where he talked about how the Fed is probably going to revise their operating framework.
I won't go into all the details, but it was to have a makeup strategy so that we would promise ex ante to let inflation run a little bit high if it were running too low. And the thought was, if people believe that you'll do that, if that's credible, then inflation won't run low. So that's all we did.
So what does that mean? So the Fed, as we all know, has...
So I'll let you go and listen to what Joseph Wang has to say about that, and I really encourage everybody to go check it out. Joseph Wang is a former Fed I can't remember exactly what he did there, but he did work for the Federal Reserve at one time. He calls himself the Fed guy. He does these great presentations at the Rebel Capitalist event, so I really encourage everybody to go check it out. Now, I have my own theories on what was just said there and what it is that Jerome Powell was communicating out there, because this is really what I have been talking about for literally years now. This all comes down to the credible threat theory. And now, if you really understand the credible threat theory in the way that I have tried to present it out there for people to wrap their heads around so that they can make decisions for themselves in the most appropriate fashions, it has been very difficult to find anything that has validated this information, because really I'm the only one, I feel, who has talked about it, until I find Joseph Wang, the Fed guy, who is talking somewhat about the monetary policy in the way that it has been communicated out there to the people. So now what I'm going to do, I don't want to make this a really long video because I know people are really not wanting to sit around for a 3-hour-long video like I like to make, doing the live streams. But you have to sit through some stuff, man. You have to kind of get through this in a way that is like, you got to, I don't know how else to explain, but you got to work for it. Right? And so it's not always going to come in a 2-minute TikTok video or even in a 10-minute long YouTube video. Sometimes you have to sit through some information in order to gather it up and understand what is really being done here. And so when we think about this communication that is happening right now, what they are going through is something called the makeup strategy. Now, the makeup strategy is essentially to make up for the fact that they were not able to achieve the inflationary scenario that they were looking for. That is a problem. Go and listen to Joseph Wang's video. Like I said, I'll leave a link down in the description for you. And this is exactly the problem that he is describing. Now, if you go back to, let me bring it up here. This is Monetary Policy Strategies for a Low Neutral Interest Rate World. He communicates that very clearly inside of this speech. And let me see if I can find it here, because you guys have heard me say it so many times. All right. I can't even find it right now. I'm sorry, guys. Oh, here we go. Thanks for sticking with me. Today we face an altogether different set of problems stemming from a very low neutral interest rate. That is, the short-term real interest rate consistent with an economy operating at its potential alongside low and stable inflation. Ironically, the problem we need to solve these days is the risk of inflation that is persistently too low rather than too high. And now this is a major problem that the Federal Reserve was facing, and the fact that they were needing to make up for this inflation that was persistently too low. They had a idea that they could use what is an average inflation targeting. It says here, average inflation targeting, whereby the central bank purposefully aims to achieve an above target inflation rate in good times, when lower bound is not constrained. Properly designed and implemented, Such an overshoot can offset the inflation undershoot during bad times, so that the long-run average inflation rate and inflation expectations are in line with the target. Now, when I think about what is just said right there, it makes a lot of sense when you hear what old Jerome Powell had to say about inflation in that.
The thought was,
Let me
I
bring
won't
it.
go into all
the Fed's framework.
Right.
Now, Chair Powell gave an interview.
So let's listen
where
again.
He talked about how the Fed is probably going to revise their operating framework.
I won't go into all the details, but it was to have a makeup strategy so that we would promise ex ante to let inflation run a little bit high if it were running too low. And the thought was, if people believe that you'll do that, if that's credible, then inflation won't run low. So that's all we did.
So what does that mean?
All right.
So the Fed, as we all know, has two mandates: price stability and full employment. Now, the operating framework is
Come on,
basically
quiet. There we go. So
promises to where we'll find.
There we go. All right. So now when we think about this, we have an inflationary scenario that was persistently too low rather than too high, and they have a makeup strategy that they were trying to push out there to get people to essentially accept the idea that there was going to be an inflationary scenario coming. Now, what I find very interesting about this is that if you really take this back to something that Ben Bernanke had to say, and this was going back to 2002, right? And so what he's talked about was the fact that you were going to run into the lower bound of zero. Where is that damn speech? All right. And this is what he has to say inside of this speech, old Ben Bernanke. He says, however, a deflationary recession may differ in one respect from normal recessions in which the inflation rate is at least modestly positive. Deflation sufficient magnitude may result in nominal interest rates declining to zero or very close to zero. Once the nominal interest rate is at zero, no further downward adjustment in the rate can occur. Since lenders generally will not accept a negative nominal interest rate when it is possible instead to hold cash. At this point, the nominal interest rate is said to have hit the zero bound. Now, what he is talking about there is that the Federal Reserve would typically, during times of economic stress or downturns, recessionary things happening within the economy, they would lower interest rates around 5%. Now, if they had lowered interest rates so far that they hit zero, they are no longer able to stimulate the economy and therefore considered to have hit the lower bound of zero, because they couldn't go negative without people just pulling all their money out in cash. So they knew that this would be it, that once they hit zero, stimulating the economy with the adjustment of interest rates was no longer an effective tool. It kind of goes on to talk about it. Because central banks conventionally conduct monetary policy by manipulating the short-term nominal interest rates, some observers have concluded that when the key rate stands at or near zero, the central bank has, quote, run out of ammunition. That is, no longer has the power to expand aggregate demand and hence economic activity. It is true that once the policy rate has been driven down to zero, a central bank can no longer use its traditional means of stimulating aggregate demand and thus will be operating in less familiar territory. The central bank's inability to use its traditional methods may complicate the policymaker's process and introduce uncertainty in size and timing of the economy's response to the policy actions. Hence, I agree that the situation is one to be avoided if possible. Now, what he is essentially saying there is that once the Federal Reserve had hit the lower bound of zero, that is it, man. Like, you are not able to use your traditional means of stimulating the economy, and this is going to be a major problem for you, especially if you are facing a deflationary pressure. Right? He goes on to say, preventing deflation. And now, of course, he's talking about every possible way to keep inflation from actually, or deflation from actually occurring. Remember, they're not worried about inflation, right? Back John Williams' 2018 speech, Monetary Policy for a Low Neutral Interest Rate World, was saying that the problem that they needed to solve was the risk of inflation that was persistently too low rather than too high. All the ideas that Ben Bernanke is suggesting inside of this speech were essentially attempted and tried. It kindly comes down to one last hope, right? Curing deflation. And it goes like this. The conclusion that deflation is always reversible under a fiat money system follows from basic economic reasoning. A little parable may prove useful. Today, an ounce of gold sells for $300, more or less. Remember, this was back in like 2002 when this speech was given. Now, suppose that a modern alchemist solves his subject's oldest problem by finding a way to produce unlimited amounts of new gold at essentially no cost. Moreover, his invention is widely publicized and scientifically verified, and he announces his intention to begin massive production of gold within days. What would happen to the price of gold? Presumably, the potentially unlimited supply of cheap gold would cause the market price of gold to plummet. Indeed, if the market of gold is to any degree efficient, the price of gold would collapse immediately after the announcement of the invention, before the alchemist had produced and marketed a single ounce of the yellow metal. So this is what he is describing as the monetary policy tool coming from the Federal Reserve in order to prevent deflationary scenario. Right? It's a credible threat. This is exactly what he is describing. And just a little addition to it, inside of this speech, if you scroll all the way to the very bottom, it had this very little interesting thing to say. The Fed can inject money into the economy in still other ways. For example, the Fed has the authority to buy foreign government debt as well as domestic government debt. Potentially, this class of asset offers a huge scope for the Fed operations, as the quantity of foreign assets eligible for purchase by the Fed is several times the stock of the U.S. government debt. So when you hear about the Federal Reserve buying up all the government debt, forcing the government to go deeper into debt and allowing them to go deeper into debt, they can expand their operations outside of the U.S. treasuries all the way into foreign assets as well. And this is something that they were talking about back in 2002. All right, so now let's kind of just do a quick review of what's going on here, because the Federal Reserve, right, and now we have to think that Ben Bernanke was talking about this back in 2002. The Federal Reserve knew that they were facing a situation in that the Fed funds rates was ever getting closer to zero. Like going back to the early 80s, the Federal Reserve had the Fed funds rate up over 15%. And then as they would go through downturns and issues within the economy, they would lower interest rates around 5% to stimulate the economy. This lowering of the Fed funds rate by 5% would get people out there buying houses and cars and going on vacation, and this would pick up the aggregate demand, right? So now, of course, they would raise rates to try and, get some of their ammunition back or try to slow the economy down. And there was lots of indicators and situations happening in which that they would be raising and lowering these interest rates, and a lot of it had to do with what was going on with employment. Now, the Federal Reserve eventually got to a point where they could see it. They're like, man, we are going to run into zero at some point. We won't be able to stimulate the economy using this method anymore of dropping the interest rates at the Fed funds level. So what is it that we could possibly do in order to deal with the economy being in this fact that we are going to hit zero and we are not going to be able to stimulate the economy, which means that we are going to be facing deflationary pressures, which means that we need inflation somehow. How do we find the inflationary pressures coming to the economy? Even though we have this printing press, how is it that we get this out there to the people in order for them to actually create the stimulating demand within the economy, which is purchases, transactions, aggregate demand? And now typically this would come from their own method, of using credit cards, going out there and taking out a car loan, going out there buying a house with a mortgage. This was their own way of figuring out how it is that they were going to get the debt out there to the economy, was through the people's own purchases, through the demand itself. After they realized that now they got it at zero, the people are debt saturated, they're not going to be able to stimulate the aggregate demand by lowering interest rates any further because they're hitting the lower bound at zero. Now it's up to the government. The government goes and borrows a ton of money and then spends that money into the economy. If we don't do it, they will. And so this is the situation in which that they had come across. Now, of course, they have to use this credible threat theory in order to get people to go out there and actually do the things within the economy that would create the situation in which that they are looking for. And this is part of the theory, right? So now, when we take this back a little bit, oops. Okay, come on now. How do I? Oh, come on, get back up there. All right. So now we go to a more recent speech, right? And this was given by Jefferson. This is given by Philip Jefferson, and this speech is May 13th of 2024, so it's not even really that old. And now, in this speech, he talks about the communications and how communications are so important in how the monetary policy is to be conducted, because it's all about expectations. Now, listen to this. In 1981, Karl Brunner, the Swiss monetary economist, called central banking an esoteric art and lamented central banks' quote, inherent impossibility to articulate its insights in explicit and intelligible words and sentences. So basically saying that that central banks had no idea how to communicate. They couldn't do it in a way that people would understand anyway. At the time, central banks' wisdom dictated that monetary policymakers should say as little as possible. Some research at that vintage tried to rationalize this, quote, secrecy through the notion that monetary policy would be particularly effective if it surprised the markets. So now this is how the Federal Reserve is now conducting themselves, is through their words. And now they know that by communicating, it's going to be very important. Listen to this. This is how they changed. Expectations became a focal point in academic and policy circles with the emergence of the new Keynesian models in 1990s as a framework for monetary policy. In these models, aligning the expectation of decision makers in the private sector with those of policymakers produced superior economic outcomes. Let me read that again. In these models, aligning the expectation of decision makers like people who are working the corporations, people like you and me who are deciding to buy a house, decision makers within the private sector, right? Expectations of decision makers in the private sectors this is aligning, right, these expectations with those of the policymakers produce superior outcomes. So if they could get the expectations to be in line with what it is that they were wanting. Mike Woodford, one of the developers of the new Keynesian model, put it this way: not only do expectations about policy matter, but very little else matters. This is, again, very important to understand, is that their communications and that they are presenting them out there have everything to do with how they conduct themselves in their monetary policy. The adjustment of interest rates, they learned, is not going to be the effective tool at some point when they hit the lower bound of zero. goes on and says this within this speech. Oops. Come on. Okay. During the tenure of Chairman Bernanke, there was another burst of innovation in the way that monetary policy was communicated. In 2007, the first SEP was published to systematically the economic outlook of the FOMC, the Federal Open Market Committee participants. The first SEP, the Summary on Economic Projections, is what that stands for. Was published to convey systematically the economic outlook of the Federal Open Market participants, or committee participants. In 2011, Chairman Bernanke started holding press conferences after every other FOMC meeting. In 2002, the Fed adopted an explicit inflation target of 2% and started publishing individual FOMC participants' views on appropriate future path of the federal funds rate, now famously known as the dot plot. During these years, Loretta, in her capacity, this is Loretta Mester they're talking about, in her capacity as the research director of the Federal Reserve Bank of Philadelphia, contributed an ongoing work of communications in collaboration with the policymakers and the Federal Reserve Board staff. Now, it's important to understand that the Federal Reserve communicates in a very convoluted, kind of confusing way, but to understand that they had started setting these ways up of getting the information out there, right? They wanted to make sure that the people understood what it is that they were trying to do, and they were communicating it out there in all these different ways, all the way down to this famously known as the dot plot. This really got everybody all worked up last year when there was supposed to be all these major amount of interest rate cuts throughout the year, and it turned out it only turned out to be a handful of them. So the dot plot thing is one of the ways that they are able to get that communication out there to the people, to get them to behave in a particular fashion. And that particular section of the speech really describes how they were setting up these little different channels of doing that. All right. Of course, this was an extraordinary time for monetary policy, as interest rates in most advanced economies were close to zero following the Great Financial Crisis. The Federal Open Market Committee employed forward guidance, explicit communication about the future path of the policy rate as a key tool to deal with the unprecedented situation. The research community had found that such forward guidance could be very effective in the context of the new Keynesian paradigm. Goes on to say here, and this is important. I'm going to finish up with this speech, and I'm going to move on to a little bit others, but this is super important to understand. When Loretta became president of the Federal Reserve Bank of Cleveland in 2014, she supported the continued use of forward guidance during these extraordinary times, in particularly to communicate the lower for longer policy that could provide accommodations in the presence of the effective lower bound constraint. Get that? This is what the Federal Reserve was like, hey, let's just keep this information going that we're going to keep it lower for longer. If we tell them that it's going to be lower for longer, this will actually create the situation in that we are looking for, which said could provide accommodations in the presence of the effective lower bound constraint. So we're constrained by the effective lower bound, but just communicate out there that we're going to be lower for longer, and it'll have some stimulating effect to the economy. And it did. All right. Okay. She also insisted that forward guidance could be used effectively even in normal times. This is the key to it. Even in normal times, as a means of clarifying the FOMC's reaction function. So very important that the forward guidance could be used effectively even in normal times as a means of clarifying the FOMC's reaction function. And so we think about what it was just said over there in Jerome Powell's interview, how it is that they were trying to get the expectation out there to create the situation in which it is that they were looking for. So I'm going to finish it up with a couple of others real quick, because this is another important part of this understanding, is that Jerome Powell on August 27th, 2020, hold on, before that, the statement on long-run goals and monetary policy strategies. This was adopted January 24th of 2012. They give this statement, right? This was way back, and they reaffirm or redo this statement every few years, like every 5 years, every whatever. They will come back out and say, okay, here's the new statement on long-run goals and monetary policy strategies. And so this is something that they put out there and then basically kind of shut up about it, right? They don't say much else. Now, this is what it has to say in here. And this is so good. The committee judges that long-term inflation expectations that are well anchored at 2% foster price stability and moderate long-term interest rates and enhance the committee's ability to promote maximum employment in the face of significant economic disturbances. In order to anchor long-term inflation expectation at this level, the committee seeks to achieve inflation that averages 2% over time and therefore judges that following periods when inflation has been running persistently below 2%, appropriate monetary policy will likely aim to achieve inflation that is moderately above 2% for some time. So important to understand that. Did you guys get that? That the committee seeks to achieve inflation that averages 2% over time. This is the goal, over time, the 2% over time. And therefore judges that following periods when inflation has been running persistently below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. So again, when we think about what it is that the Federal Reserve was attempting to do within the inflationary scenario that we were experiencing, they were trying to get this inflation to be moderately above 2%. This is a speech given by Jerome Powell August 27th of 2020. Says this: the persistent undershoot of inflation from our 2% long-run objective is a cause for concern. Many find it counterintuitive that the Fed would want to push up inflation. This is before inflation took place, by the way, guys. Right? This is August 27th of 2020. COVID was just kicking in. The shortages hadn't happened yet. The inflation hadn't happened yet. It was about ready to. Right? Many find it counterintuitive that the Fed would want to push up inflation. After all, low and stable inflation is essential for a well-functioning economy. And we are certainly mindful of the higher prices for essential items such as food, gasoline, and shelter, and the burdens faced by many families, especially those struggling with lost jobs and incomes. However, inflation that is persistently too low can pose serious risks to the economy. Inflation that runs below its desired level can lead to an unwelcome fall in long-term inflation expectations, which, in turn, can pull actual inflation even lower, resulting in an adverse cycle of even lower inflation and inflation expectations. Wow, sounds very similar to the problems that Ben Bernanke was talking about, doesn't it? How the deflationary scenario can end up being the major problem coming to the Federal Reserve and that they would need to be doing something about it. Well, Jerome Powell, he recognized that as well. Goes on to say this: we have made important changes in regard to the price stability side of our mandate. Our long-run goal, continues to be inflation rate of 2%. Our statement emphasizes that our actions to achieve both sides of the dual mandate will be most effective if the long-term inflation expectations remain well anchored at 2%. However, if inflation runs below 2% following economic downturns but never moves above 2% even when the economy is strong, then over time inflation will average less than 2%. Households and businesses will come to expect this result, meaning that inflation expectation would tend to move below our inflation goal and pull realized inflation down. To prevent this outcome and adverse dynamics that could ensue, our new statement indicates that we will seek to achieve inflation that averages 2% over time. Therefore, following periods when inflation has been running below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. Right? What's moderately above 2%? Is it 2.2, 2.6, 3, 4? I would assume that we're somewhere moderately above 2%, right in line with the Federal Reserve's goal. Let me read it again. Therefore, following periods when inflation has been running below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. In seeking to achieve inflation that averages 2% over time, we are not tying ourselves to a particular mathematical formula that defines the average. Thus, our approach could be viewed as a flexible form of average inflation targeting. Our decisions about appropriate monetary policy will continue to reflect a broad array of considerations. It will not be dictated by any formula. Of course, if excessive inflationary pressures were to build, or inflation expectations were to ratchet above levels consistent with our goal, we would not hesitate to act. See how this is playing out in today's economy? The Federal Reserve was in desperate need of an inflationary scenario that they could not find. The great financial crisis that happened after the Ben Bernanke speech that he was given expanded the Fed's balance sheet from $850 billion to over $4.5 trillion, and they failed to produce the inflationary scenario that they were looking for. In 2018, John Williams gave a speech, Monetary Policy Strategies for a Low Neutral Interest Rate World. In that speech, he talked about how they should use something called average inflation targeting. Right now, the Federal Reserve is using something called flexible average inflation targeting. It is not well known, it is not well communicated, and it is very, very much what is now taking place within our economy, in that the Federal Reserve does not look for a 2% target, but seeks to achieve inflation that is moderately above 2%. They are doing this because of something called the neutral interest rate. That is the rate that is neither accommodating nor restricting the economy. And because that neutral interest rate is very low, in fact it's close to zero, they have very little room to actually stimulate the economy with the lowering of interest rates. That is why they have built the communication tools. That is why they are using the forward guidance. That is why they are so active out there inside of the mainstream media with their interviews and comments and statements. It is why it is such a known thing that the new president administration wants to take power over the Federal Reserve, wants to switch out chairmen, all because of the credible threat aspect to it. It very much works. Once you see it, it becomes very clear. It's very difficult because not too many people are using it within their strategies, so most of the people that you hear out there have no clue about any of this information that I presented to you today. Uneducated Economist, you let me know.